Production and distribution of City Club forums on IdeaStream are made possible by the generous support of PNC and the Raskin Family Fund, with additional funding from Robert Conrad, Cleveland State University, the Chautauqua Institution, the Cleveland Clinic, and the United Black Fund of Greater Cleveland, Incorporated.
I've never done it.
How often do you get to do that?
Good afternoon, and welcome to the City Club of Cleveland. I'm Steve Koff, Washington Bureau Chief for Cleveland.com, and I'm pleased to introduce today's forum, a panel discussion on tax reform. On October 25th, President Donald J. Trump tweeted, "This will be the biggest tax cut in the history of our country, and we need it." Since the beginning of his campaign, President Trump has called for a significant rewrite of the United States tax code, which hasn't happened since the Reagan administration. The long-awaited tax reform bill, the Tax Cuts and Jobs Act, is now working its way through Congress. On November 9th, the House Ways and Means Committee passed a version of the bill. The entire U.S. House of Representatives and Senate Finance Committee passed their respective versions a week later, on November 16th. Earlier this week, the Senate Budget Committee voted to advance the plan. Then yesterday, as the Senate inched closer to passing its plan, the Joint Committee on Taxation said the bill could add $1 trillion in deficits. And that sent the Senate scrambling last night and early this morning to look for ways to change the bill so it either won't create that level of debt or at least will appease the senators who worried about it. There are several key similarities and differences between the two pieces of legislation in the House and the Senate. Both cut taxes for businesses and individuals. However, the scope and timing of those cuts differ. Today, we'll dissect the House and Senate bills, the implications for higher debt, spending cuts, enrollment in the Affordable Care Act, and on subsequent political decisions the bill could spark. And of course, we'll take your questions. We have assembled an impressive group of regional and national leaders to offer their perspectives. Joining me on stage are Jared Bernstein, Senior Fellow at the Center on Budget and Policy Priorities, and a former Chief Economist and Economic Advisor to Vice President Joe Biden. Grover Norquist, President of Americans for Tax Reform, and Marna Ricker, Central Tax Managing Partner for Ernst & Young. And with that, let's begin. So I've spent a lot of time covering potential tax changes lately, so much that I had a dream about taxes the other night. I thought I had come up with a neat new tax deduction, and in my dream, I found a way to commercialize this deduction and make money off of it like a royalty. It was brilliant. And then I woke up and realized it was going to get me audited. So let's talk about dreams. Grover, what would be your dream or your ideal for the individual and corporate tax rate? And how close to your dream is this package that Congress is working on now?
Well, Samuel Gompers, the labor leader, was asked what he wanted, and the answer was more. So what I would like on the corporate rate and the individual rate is lower, and to bring it down as much as possible, as quickly as possible. There is an argument for a zero tax on corporate income tax, because corporations don't pay taxes. They collect taxes from you, and they give them to the government, and they allow politicians to act like they didn't take your money. But they did. So I think lower. I mean, right now, European average is around 20-something. We have average 5% corporate tax rate at the state level. If we went to 15, we'd be just at or below the European average. That'd be a good start. That's where Trump wanted to go. I think it's still where we should go in this tranche, but I'm open to an argument for lower. What
about individual? What do you think should be the top marginal rate for the highest earners?
Well, when Reader's Digest used to ask the poll, how many people what's the highest anyone should pay? Almost very few people think anybody should pay more than a quarter. So there's a sort of a consensus on that. It's not a bad start. It's where we were before Hoover started raising taxes up to 75. As a top rate, 25%.
Mm-hmm. Okay. So, Jared, in reality, we cut taxes, and how does that work? How would that work for our government and for our society? Well, we'll deal with the mechanics of things like pay-go and mandatory cuts later, but I'm interested in how that works out in a place where the use of taxes funds a lot of programs, social programs, economic programs. We're here in a city with a 36% overall poverty rate, a 53% poverty rate for children. So there are a lot of government programs funded by federal income taxes. We cut federal income taxes. Does this impact those programs? Does that hurt the people of the city of Cleveland? Or perhaps does it not hurt because we make up for that in greater economic activity?
No, the $1 trillion added to the deficit and debt through this plan is after accounting for economic activity. And so I'll answer your question in a second, but first I want to say it's great to be here in Cleveland, and great to be out of the swamp for a day. On my way from the airport here, I got stuck in a traffic jam. And people say they don't have traffic jams in Cleveland, but they did this morning, and I thought that was a great thing. So good for you, Cleveland. You're coming back. Not at DC levels yet, but you'll keep working at it. No, that is one of the you talked to Grover. Grover's dream is my nightmare. I thought so. And precisely for this reason, not only does this plan raise the debt by $1 trillion over 10 years, at least $1 trillion. One of the ways it does, one of the reasons you get into these kinds of deficit and debt problems with this plan is because of the magnitude of the cuts that it administers. And these cuts broadly benefit our corporate sector far more than middle or lower income households. And I know Marna's going to have a lot to say about the corporate side of these changes. Amazingly, the corporate cuts, the cut in the estate tax, which is nothing more than a gift to the wealthiest of heirs. The estate tax reaches only the top 0.2% of estates. So this is basically a gift to the richest of the rich heirs. The estate tax keeps going. That lives forever. The corporate cuts, they just keep going. They live forever. The elimination of the AMT, which was why Donald Trump had to pay $31 million of taxes in 2005. That was the one page of his tax returns that were released. It turns out he got dinged pretty hard by the AMT. That's eliminated forever. But the personal side, some of the things that help moderate income families, they all expire in 2025. And by 2027, 150 million families either pay more taxes or gain very little from this plan. So this is a plan that takes from the middle class, gives to the wealthy at the cost of at least $1 trillion. Now, why do I keep saying at least? Because Republicans say, when I confront them with this reality, and this is all from nonpartisan budget scores, CBO, JCT, so this is not some liberal cabal speaking. When I hit them with this, they all say, well, Republicans will never let that happen. We won't let the tax rates go up the way they're scheduled to go up in this plan. We will step in and we'll extend them. Well, that turns $1 trillion into $1.5 trillion in terms of debt. So remember, you can't extend without increasing the indebtedness. This is particularly important to places like Cleveland for the very reasons you noted in your question, and we can get into that more as we go along. But the second stage of this, and Marco Rubio, Donald Trump, Paul Ryan have been extremely clear about this. The second stage of this is after transferring hundreds of billions of dollars from the coffers of the Treasury to corporates and multinationals and heirs of wealthy estates. After that, the second stage, when the growth effects fail to appear, and I told you, the $1 trillion is after considering growth effects. After those growth effects fail to appear, Republicans are going to wake up and remember, oh yeah, that's right, we don't like deficits. And then they're going to start cutting. And we already hear talk about cutting Social Security, talk about cutting Medicare, talking about the safety net. In fact, some of those cuts are going to be automatic. And I know we're going to get to that.
And I got questions on every one of those. And Grover, I'm going to have an opportunity for you to respond to a lot of those things because I'm sure you want to. But I want to bring Marna into this.
I think I might want to stay out of this.
Well,
for being honest.
It is probably a good idea.
Yeah. Too late now.
I know where I'm sitting here.
Marna, what could tax reform provide that clients of Ernst & Young and similar firms need? And are people, like, as Jared right, in saying that this is a giveaway to corporations, or are they wrong? And why are they wrong if they're wrong?
Yeah, so I'm not going to state whether they're wrong or they're right. I'll try to just stick to the facts about it. I mean, I think we did a business roundtable study, and in that business roundtable study, it talked about there were 40. We went back and looked at if our effective rate, corporate rate, had been closer to 20%, more competitive rate globally, and if we didn't have tax on repatriated earnings, right? If we let companies bring cash back freely. So we went back and looked at that over about a 10-year window of period. 4,700 companies would have stayed onshore here in the U.S., right? Or wouldn't have been acquired by, wouldn't have converted or wouldn't have been acquired by a foreign target.
Why is that?
4,700 of them.
Can you explain the mechanics of why that would happen?
Yeah, it's just the mechanics of the rate, right? So the cost that what companies pay here in the U.S. in taxes, very, very different than what they pay overseas. And so the ability of foreign acquirers to acquire U.S. companies has gone up tremendously. And so that's another stat. Again, these are just facts, right? You can decide whether they're right or wrong. I'm just giving you facts from the study.
Is there a dollar amount to the 4,700?
The $4,700 amount, I think, was $1.75 billion change.
And this is a survey
in
you're
assets.
citing?
This
survey?
is a study.
But I mean, is it a survey? Is it you ask the businesses and this is what they say they would do?
No, it's just economically looking at the transactions that have happened over the last 10 years.
So they did bring the...
This is the path.
Just economically looking at the transactions that have had, if it was a 20% effective rate, what would have been the change in the rate, in the amount of assets that left the U.S. So like I think it was $1.75 billion worth of assets left the U.S. over the last roughly 10 years. Right? So again, I'm not stating whether that's why they left, right? I'm just simply stating those are the facts. Another fact that I think is relevant from a corporate perspective to think about is, we're acquiring companies, U.S. companies are acquiring companies overseas, U.S. companies are targets, right, of companies overseas. And so as an acquirer, we've gone from 18% down to 16%. So we're acquiring now 16% versus 18%. As a target, unfortunately, we've gone from 13% to 30%. Right, so U.S. companies are being acquired by foreign multinationals, right? And so that, you have to just question whether that is good for jobs, whether that's good, obviously, for growth here at home. So those were just some facts from a corporate perspective.
Okay, so let's come back to this budget framework that to make this package work under budget reconciliation bills. The Senate reconciliation package has come in at a cost of no more than $1.5 trillion, and even before you start talking about the debt and therefore the problems that held the bill up last night, you're talking about a package that said, well, to make the math work, we have to stop the individual cuts. We'll continue the corporate cuts, but we have to stop the individual cuts, and they're all going to expire after 2025, and we'll have some other things that go on. What is your level of confidence, Grover, that in 7 years or sooner with some of these, that Congress, with a very different, potentially very different makeup, will let those cuts expire or will extend those? Jared already talked a little bit about what the economic costs would be if you extended them, but what's your level of confidence that Congress would even do that?
The reason some of the cuts are temporary and some of them are permanent is because of the Senate rules and the Byrd rules. You have to fit all this stuff in and has to be deficit neutral at certain times. And if they want to have silly rules, we'll write to their silly rules. But we needed to have those factors, those tax rates that affect decisions. Corporate marginal tax rate. You can't ask companies, please don't get bought by foreigners because there might be a tax cut in your future and you could stay. Or please invest $500 billion here doing something or other because maybe we'll cut taxes. Well, we think we will, but we don't know, and who knows, maybe. They won't. They don't. So what you needed to do, and what they did do, was they made permanent getting rid of those things that people have to plan for over 10, 20, 30-year periods. And they made temporary those things that we fully intend to make permanent. The full and immediate business expensing, moving from long depreciations to expensing. So like 5 years in the House bill. That's awful lot like the R&D tax credit. Even when the Democrats ran things, the R&D tax credit got extended every 2 years because it was such a powerful, important piece. And this is much more pro-growth than that was. It was the vice president who agreed to make permanent 85% of the tax cuts that were in the Bush tax cuts, which were disappeared in year 10, and then again in then kept going for 2 years by Obama, and then you guys negotiated making that permanent. We will make the individual tax rates permanent, the individual tax credits permanent, and these will move forward To the question of whether we can afford it in the deficit or questions, which strikes me as odd because I had conversations with each of these folks. CBO, which is wrong about a lot of things like how many people are going to buy Obamacare by factors of 2. So citing them as some sort of independent factor is a little bit odd, or joint tax. But CBO does give you this number, which they claim to like, and that is that over a 10-year period, if the economy grows not at 2% a year, Obama levels, French levels, but at 3% a year, that the federal government nets, not with tax increases, but just nets out of economic activity, more people working, higher wages, government takes more money, about $2.5 trillion. Now, the Reagan tax cuts brought 4% growth. We've already gone from 2% to 3% in the first 3 quarters of this year with a change in regulatory policy, not a change in tax policy. But the argument that we couldn't increase growth rate by 0.4% with a dramatic cut in corporate rates and the other faster depreciation schedules and some of the other changes, going to a territorial tax system rather than the worldwide tax system that we in North Korea have. These are very powerful drivers of growth. If you think, well, we won't get 0.4% growth, then we would not hit the 1.5 trillion. I think it's extremely likely we'll do significantly better than that, and that this 1.5 was a low estimate that Corker agreed to, which is why it's so odd that he was arguing about the 1.5 now. This is his number, it's the number he picked, to use instead of scoring, because people didn't trust the scoring or that it would get done on a timely or accurate basis. So I think as you look forward 10 years, you will see sufficient growth to more than pay for the lower taxes on a static model. But the idea that the government gives you money when they fail to take your money strikes me as odd. You talked about gifting money to people who earned it. You earned it. The government says, we're going to take it. We're not going to take that much. Oh, you just gave me something. When you walk down the street and a mugger forgets to mug you, and he didn't give you your wallet. That was your wallet. But it does show the difference, the very stark difference between the two political philosophies. Is what you earned yours to start with, or does it all belong to the government and they dole it out to you on taxes? The idea that big government would stop poverty. We spent 50 years spending, I don't know, $13 trillion on that, and those low income numbers didn't improve after $15 trillion. The idea that we spend another $15 trillion on another great society and that will help Cleveland, it didn't help the last 50 years. It's unlikely to work this time. So it's a policy that we know that's failed the welfare state, and we prefer not to look at Europe as the future for us.
I want to let Jared respond, but I want to add one more element into this, because it's an article of faith, whether you're accepting the Joint Committee figure or some other figure. It's an article of faith among the Republicans that if you cut taxes, especially the corporate taxes, the economy will grow, partly because companies will reinvest those tax savings into plant and equipment and personnel. Yet, you're familiar with the poll conducted by the Booth School at the University of Chicago, where top economists, Nobel Prize-winning economists, were polled, saying, do you think that this is going to happen? They weren't so sure. Bloomberg reported this week that Cisco Systems...
What do you mean this is going to happen? What's this?
They will reinvest, and therefore they will take that tax savings, reinvest it in plant equipment, and there will be more jobs. Right. Bloomberg reported that Cisco Systems, Pfizer, Amgen, Coca-Cola said they'll turn most of the gains over to shareholders. We saw what happened when I believe it was Gary Cohn quizzed an audience and said, so how many of you are ready to reinvest this? And he got very, very few hands. So what makes us so sure that that's going to happen? And maybe, Marna, you can enter into this after Jared mentions his thoughts on this, is what are the expectations you're hearing from corporate clients?
So who do you want to go?
Jared, you go.
Oh, good. Good choice.
I think he said Marna.
So Grover and I have, as you said, some philosophical differences, and I'll speak to those, but there's also some disagreement on the facts, some basic facts that I think you pretty egregiously misstated there that I'd like to correct. So first of all, on the philosophical part, which is actually really interesting, I would argue that Grover deeply devalues any of the public goods that we use our taxes for. And here's a factual difference. So Grover stated that our investment on anti-poverty programs has been completely ineffective. We fought a war on poverty, and poverty won, is the old Reaganism way of putting that. In fact, if you actually measure the decline in poverty, accounting for the expansion in the safety net, so the increase in the earned income tax credit, which has been a really important function of that. By the way, Ronald Reagan's favorite anti-poverty program. If you add in the benefits of nutritional supports, housing supports, you will find that poverty rates are down 40% since the Great Society. So it's factually incorrect to claim that these tax dollars have all been wasted and that they haven't helped the poor at all. They've helped considerably. It's factually incorrect to say that the Reagan tax cut led to 4% growth. I know no economist who would support that statement. There is no tax.
What was the growth?
Can we not interrupt each other?
You cannot interrupt each other. Keep the answers short so that we can keep track.
Thank you. So there is no economist, no economic analysis that would find any tax cut that would generate 4% growth of GDP. Grover said that the rules that the Senate is playing by enforce deficit neutrality. No, the rules which they wrote allowed them to increase the deficit by 1.5 trillion. And they did. Their plan actually goes up, at least in the Senate, 1.4 trillion, and then the agencies get in and score it, and they gave it credit for about 400 billion, so that's the 1 trillion added to the debt. So the rules do not enforce deficit neutrality. That's wrong as well. The chain of events that you've described, and Marna, I'm skeptical of, yes, if you ask corporates, do we want a big tax cut? Damn right we do. And did we, would we offshore less if you give us a big tax cut? Oh, yes, I guarantee you we will. In fact, in my view, and we should argue about this because I'd be interested in, I'd be interested in your take. I believe that this bill and the move to its changes in international taxation actually incentivize more offshoring and definitely, and this is by the Republican scoring, increase the trade deficit, which is pretty damaging for a place like Cleveland. The chain of events that Grover and maybe Marna is thinking of is one wherein corporate rates are cut, after-tax corporate profits go up. I absolutely believe that. I think that will happen. If we do this plan, we cut corporate rates by 15 percentage points, their profits will go up. I should note that their profits are already near an all-time high. So I don't think they need the break, but they'll go up. Then, allegedly, they'll invest more. That will mean more productivity, and that will trickle down. There's the word, trickle down. That will trickle down to working people's paychecks. There's no correlation between corporate tax cuts and investment, so that link in the chain is broken. There's no correlation between corporate tax cuts and productivity growth, so that link is broken. And there's especially, in our age of inequality that this plan would exacerbate, there's especially no correlation between faster productivity, higher corporate profits, and median compensation, median earnings, median income. The middle-class family has been left behind. Even if your magic fairy dust works and there's greater corporate profitability, you simply can't count on that trickling down to the middle class.
Magic fairy dust. I know, Marna, you really didn't want to talk politics
No.
and talk policy, but so let's instead of calling it magic fairy dust, call it an economic theory. What do you hear from your clients?
I like that.
Yeah.
So I think the thing, I'm not going to opine on that either way, on either side of this, truly. But what I would say is that uncertainty is horrific for corporations, right? And I think we've been caught in this pattern of uncertainty for quite some time in terms of what ultimately is our tax policy, right? That's what I would say. I'm not advocating for what the rate should be. I'm not advocating, for what the bill should look like. But I would say that coming to some level of certainty, there is billions and billions and trillions of dollars offshore. There are trillions of dollars sitting on the balance sheet of these companies.
What's the best estimate?
And they don't know 3 trillion is the amount offshore. Offshore. I don't know the balance sheet amount, but again, lots and lots of cash sitting on the balance sheet of companies waiting to make investment decisions. and where to make those investment decisions. That's what I would say to you. That's not fairy dust. That's factual.
There are still countries with competitive and tax rates, and will continue to be competitive. Ireland is a good example of that. We can look at the Bermuda and Cayman Islands and what we've learned recently about Nike and Apple and companies that have intellectual property, and they don't have to worry so much about where they're going to move a product. It's where they house their copyright or their patent. We could go local. In fact, an example in Cleveland was Eaton Corporation, which inverted to Ireland. It had operational reasons, perhaps, to be, not perhaps, it did have operational reasons to be in Ireland, but taxes were a factor, the lower taxes. If global markets are always going to be attractive for both operational reasons and for tax reasons, won't companies always chase a lower rate somewhere? And Marna, do they have a fiduciary obligation to do so?
It's a good question. I'm not going to comment on that, on whether they have a fiduciary obligation to do so or not. But I do think, again, just a couple of stats that I think are relevant to, I know you don't trust U.S. companies to invest in America, it sounds like, and just in the stats that you were saying there's no connections. But so let me give you a couple of facts on this. So companies that have U.S. supply chains, so again, keeping companies here in America, 90% of those companies buy 90% of their supplies from U.S. suppliers. 90% from U.S. suppliers. 4,700 companies left. They no longer buy 90% from U.S. suppliers. So I'll just give you that as a fact. If you look at R&D, for every time I'll do R&D second. Every time that a corporation gets 100 new employees overseas, they typically add 124 employees here in the U.S. So again, just corporate facts on investments. So you said there's no linkage. I would argue that those are just some facts to give a little bit of linkage.
Just to be clear, I said there was no linkage between tax cuts and what you're describing.
Okay, fair.
Okay. We're going to run out of time here soon. I have so many more questions I could ask, but I think the audience will have some great questions. So we'll get into the audience questions in a minute. But first, I want a lightning round. I want a one-word answer from each of you.
Good luck.
Will President Trump have we need it for the time. Will President Trump have a tax bill on his desk to sign by early next year? Will the president have a tax bill to sign by early next year?
Yes.
Before Christmas.
Yes.
Will all the tax cuts we get next year really expire before 10 years are up?
None of them will.
Yeah, I tend to agree.
You tend to agree? Marna, you have a feeling on that? Okay.
Yes.
Okay, good. 3 years from now, assuming there is not a global calamity and that we have the tax cuts, what will our rate of economic growth be? The most recent quarter was pretty strong, 3.3%. What will it be 3 years from now?
I can't give a one-word answer because the 3.3% is an annualized quarterly growth rate. The trend growth of GDP right now is about 2.3%, and I think it'll be about the same.
Okay.
3.5.
3.5.
It's 3.5.
3.5. Okay.
This is a testable hypothesis.
Yes,
That's why I'm the happy camper on this panel, and you're not.
I might add that,
We'll see.
I might add that these rates are a lot low, not a lot. They are lower, a point or more lower than I'm hearing from some in Congress claiming, and from the White House.
Oh, and I think it's much higher than that, but I thought I'd go with something that was bulletproof and trouble.
All right, yeah, it won't cause you trouble later.
We've been through this once before. Everything that was just said against this tax cut was said against the Reagan tax cut, and growth for the next 7 years was 4% plus. 4%, didn't come from nowhere.
Yeah. Reagan raised taxes 11 times.
The net cut, yes, and I wish he hadn't, but the net cut was overwhelming, and the rate reduction went from 70, we used to have a 70% top rate for individuals, to 28. That's a rate cut. And overall, taxes fell.
We'll continue this because we'll have some audience questions. Are individual tax rates right now fair?
Individual tax rates?
Yep.
These are not one-word answer. The tax system, there's a ton of unfairness embedded in the tax system.
Taxation is taking money from people who earned it and not giving it to people who didn't necessarily earn it. Fairness is not part of it. The tax rates are more destructive than they need to be to raise the same amount of money.
Today we're enjoying our Friday Forum on the Tax Cuts and Job Acts, featuring Jared Bernstein, Senior Fellow at the Center on Budget and Policy and former Chief Economist and Economic Advisor to Vice President Joseph Biden, Grover Norquist, President at Americans for Tax Reform, and Marna Ricker, Central Regional Tax Managing Partner at Ernst & Young. Our moderator is Cleveland.com Washington Bureau Chief Stephen Koff. We're about to begin the audience Q&A. We welcome questions from everyone, City Club members, guests, students, and those of you joining via our radio broadcast or webcast. If you'd like to tweet a question, please tweet it at the City Club, and our staff will try and work it into the program. Holding the microphones today are content coordinator Bliss Davis and our membership and customer service manager Corey Isler. May we have the first question, please?
I'm a CPA, and I love taxes, the discussion of taxes and tax cuts especially. I've been around for a long time, and every time it comes out, I get my spreadsheet out. When the House bill passed, I got my spreadsheet out, but I saw something, and I thought it was a glitch. And I called the politicians, and I called Rob Frost from the Republican Party, and Jane Timken, and I said, there's a glitch here, because I was finding that taxpayers, primarily, let's say single, that make between 75 earned income, 75 and 250,000, live in high-tax Cuyahoga County, pay lots of taxes, give lots of donations to the community, may have medical expenses, we're all paying more. And I expressed that, and they said, you're wrong.
What's your question?
Everybody gets a cut.
What's your question?
My question is, to the accountant and to others, do you see in your numbers people who itemize in medium tax states getting an increase?
Yes.
In each of the income groups that you look at, joint tax has pointed out that they all get tax cuts. They tried to stick in one where they claimed that people who chose not to go into Obamacare would also not get tax credits because they didn't choose to go into Obamacare, and that would somehow raise their taxes because they weren't taking a tax credit because they chose not to. If you take that out, every single income group in the country gets a serious tax reduction, which is very helpful. Are there some people, if you organized your life around existing tax deductions and credits, same things with true of the business community.
Right.
Some businesses that take advantage of all the loopholes that you can get will probably be held basically harmless but not do much better. I've talked to some of them, and it's possible that you could organize your life around tax deductions and credits and not do as well, but over time, people who had organized their lives around being told what to do by tax credits and deductions will do differently. Similarly, the high taxes in certain states, income taxes and property taxes, when this passes, the Democrats have already announced in New Jersey they're not doing a millionaire's tax because the tax deductibility is being taken away for their high income tax, and other states are looking at cutting their income taxes. So you're not going to have those kind of problems because even corrupt cities and incompetent governors are going to have to bring those rates down.
Jared, I'm going to let you respond, but let's keep the answer short, but go ahead.
I'll try. Because the question is very well taken, and to me what Grover just said is just tap dancing around the reality, which is what the questioner brought to the table, and I think we should be more accurate and more honest about what the actual tables show. By 2025, when the personal side of the tax plan starts to fade out, as legislated, tax increases go into effect, and by 2027, 150 million people below 200,000 see either a tax increase or no gain or a marginal gain. Now that's 2027, and maybe it won't happen. Maybe there'll be changes.
You just said it wouldn't happen.
And if it does, let me finish. If it does, the deficit goes up even higher. And the people that you're talking about get dinged two ways. First of all, they get dinged, and you don't have to wait for 2027. This is 2018, and this is precisely the exemptions you're talking about. If you're a family with high medical expenses and that deduction gets eliminated, you're facing what could be a whopping increase. The Wall Street Journal yesterday featured a family in California whose income was Iowa, whose income was $90,000, so we're not talking poor, whose taxes would go up in 2018 $2,600 if this plan passed. So that's a 2018 reality. The second part, and this gets to Grover's point, yes, I'm afraid they probably will extend that. And that means deeper cuts. That means deeper cuts in Social Security, in Medicare, in Medicaid, in the safety net, and that redounds to the disadvantage of families who depend on those programs for their economic well-being.
I want to get back to the audience questions, but
One
Grover, I'd
second
like
on
you to,
that.
yeah, I'd like
Question
you
my
also to
honesty
respond.
on this stuff. Outside, you can pick up the actual JCT report with the numbers, and you can go through each one. They're actually written down, so we don't have to make nasty comments. Secondly, we have a situation where these are going to be extended, but your comment that somehow Social Security and Medicare are under attack, that has been the Democrat talking point for the last 70 years.
What about PAYGO, though, with Medicare?
Right. It's not what you're going to have with both Medicare and Social Security. The President has said this, the House and Senate Republicans said they are off the table. That's not part of any discussion of any pay for.
It's not true.
What you will look, no, it's true.
It's not true.
I talk to them, I work with them, you don't.
They need 60 votes in the Senate for to waive PAYGO. True or false? Do they need 60 votes to waive PAYGO?
You need 60 votes to
Thank
waive
you.
PAYGO.
Okay.
Anyway,
Will Democrats...
There are 52 Republicans.
But
Right.
you've got the political reality, therefore forcing Democrats to vote.
Democrats are not saying that
For
they will
PAYGO.
support this. They're not saying they won't, but they're not saying they will. Correct?
You're not going to end up, what you are going to have next spring, and we get here in April, because people who are talking about deficit, in April we have another reconciliation package. There you're going to go back, and the welfare programs are going to be block granted to the states, and which is what Clinton did, but Obama undid a lot of the progress that was made by Clinton in terms of work requirements and time limits. And as you do that, you simply say it's going to grow a little less quickly than it is today, saves a fair amount of money over time, reduces the unfunded liabilities, which is debt. If you don't do anything about unfunded liabilities, as people who are paying the pensions for the guys in the city and the state know, they become debt. They're unfunded liabilities waiting to become debt. And so that fix there is going to significantly drop the total cost to government and swamps any of this discussion about tax cuts right now. So I'm less concerned about it. I mean, because I know that and I've had this conversation with the senators, they all know that significant spending restraint is in the next tranche. That's what we focus on in the 2019, next year's reconciliation package. So it's fine to talk about deficits and deficit, but to talk about it only in this context and not realize that there's actual reform that will be underway and that will be enacted next year is to miss the point of what's going to happen.
I want to come back to that, but let's get back to the audience questions.
It seems like the entire discussion has been predicated on the idea that economic growth will be beneficial in the future as it has been in the past. But we've entered a new era of human history, and scientists from many disciplines have concluded that in order to save the planet, we need a steady state, no growth economy. Don't we have a moral obligation to transition away from industrialized capitalism to an economy that fits within the carrying capacity of the earth, and to do it quickly?
Question?
Go ahead.
Yeah, the argument that there are limits to growth is one that was invented and put up when Carter had lousy economic growth, and it couldn't be the taxing and spending and inflating the currency was a problem. There was Club of Rome. We all knew there were limits to growth. This couldn't happen. Reagan turned around. Oh, my goodness, growth. Deregulation and lower taxes, strong economic growth, 20 million new jobs. We weren't going to have any more new jobs because they were all going to be automated and sort of thing. And with 8 years of very slow economic growth under Obama, the same collection of people, a little grayer, same collection of guys have all trapped out and said, you know what, there's no more growth anymore. There's going to be robots. There's, there are no jobs for farmers. Yes, there are jobs for farmers. When people move from one part of the economy to another over time, we don't have 75% of us on farms today, and there will be new jobs. Not everybody's job is going to disappear with a robot. But this argument that there are no more jobs and there is no more growth is trotted out for political purposes at certain times. And we just had 8 years of very bad growth under Obama, where everything he wanted to do, we did, and it didn't work very well. We're now entering a different thing, and the argument is, oh no, that wasn't 8 years of failure. That's the new normal. Well, we'll now decide, and we'll now see whether that is the new normal. I don't think it is.
Okay, so first of all, the questioner was asking about the impact of climate change on economic growth, not automation and robotics. So let me speak to that. But I want to just make sure everybody recognizes that Grover goes Reagan, Obama, and leaves off Clinton. Okay, so Bill Clinton raised taxes. The budget went into surplus under Bill Clinton. The debt came down under Bill Clinton. Under Ronald Reagan, the debt went from 25% of GDP to 40% of GDP. So this notion that you cut taxes, and of course Reagan raised taxes when he recognized the damage that some of his early cuts had done to the budget. The notion that you raise taxes and growth breaks out everywhere, you can't get there by only focusing, you can't get there and simply cite Reagan. You also have to cite Clinton, who of course raised taxes. Here's the thing about your question. There should be no question in any of our minds that the impact of human activity on climate is already having devastating impacts on the globe. That doesn't mean that we have to push for zero growth. It means that we have to push for growth that is compatible with renewable energy, with sustainable growth. And that means investments in solar, wind, renewable energies, battery storage. And there's green industry that ought to be built up there. One of the problems I have with this tax plan, and I think Grover himself said it, is that soon we're going to turn to spending restraint. Okay? And they're also going to point to the $1 trillion budget deficit that they just added to, if this passes, and say, oh my goodness, we need spending restraint. Well, it's precisely those kinds of measures that disable us from investing in the kinds of infrastructure, green jobs, sustainable growth that is so needed. And by the way, one of the things you see now is the impact of these hyper-intensive storms, which scientists tell us is unequivocally connected to climate change. Who foots the bill for that? The government. And the congressmen and the senators run around trying to figure out how they're going to pay for these disasters. And meanwhile, they're running up the deficit by $1 trillion on a bunch of regressive tax cuts that the corporate sector, God bless them, doesn't need. They're already hugely profitable.
Just to clarify a point, is spending restraint right around the corner? Is spending restraint? This is part A. Part B follows with spending restraint, whether through pay-go or not.
No, it's entitlement reform. Entitlement reform.
Well, you call it entitlement reform. I think Jared would call it spending restraint or cuts too.
Well, by reform, do you mean cuts?
What we're looking at doing, and I'll make it clear, it's what Clinton did on welfare. Okay, if you want to understand it, take a look at Clinton's. What he did was he block granted it out to the states, and then it continued to grow, but not as rapidly as it had been in the past. And every state except Hawaii actually ended up doing better and was able to manage reducing the cost, making sure that people who needed help got help, but also getting people into the labor force. You mentioned that I left out Clinton. I didn't mean to. Clinton was one of the drivers of economic growth in this country. When he raised taxes and gave the Republicans control of the House and the Senate, the stock market did this until that happened. In the next 6 years, we cut the capital gains tax. We had strong economic growth. We had significant deregulation. We had some real progress during those 6 years where the Republicans in the House and Senate ran the country and Bill Clinton was otherwise engaged. So this is not a problem to look at the Clinton years. We should look at the Clinton years. I appreciate Clinton's gift to us of a Republican House and Senate, and we've held both of them most of the time since. Not all.
Audience question.
Going back to the subject of our program today, what form will tax reform take? In Washington, if you raised the corporate rate from 20 to 22%, wouldn't that solve the deficit issue, and then we could get this thing through?
If you raise this corporate rate from 20, which we said we wanted to go to 15, we compromised to 20. If you go from 20 to 22, you do what George Herbert Walker Bush did when he broke the agreement that we all had on tax reform, which was a top individual rate of 28%, which would have solved the problem for all the pass-through corporations if they were at 28% instead of 38+%. So it's very important that when you give people a number, the business community, individuals, that you hold to that number. Any give at all, which is why I'm arguing publicly with Rubio, who wants to raise the tax and do some other stuff. Once you raise that tax, if you say the 20% rate is a piggy bank for anybody's goofy idea, then it'll go 28, 22, and keep going up, as Bush did when he broke the glass ceiling on 28, and we ended up way beyond what he intended. But if you unlock that, you're not in charge of what happens. It's going to keep drifting up. So I'd strongly argue against that, and I would argue growth will, okay, go to Bill Clinton. I spoke at a panel like this 2 days ago with Mark Penn, who is Bill Clinton's chief manager, and then Hillary's as well, for the campaigns, but also serious pollster and political activist in his own state. And he said what gave us the opportunity to balance the budget in the late 90s was growth. That none of their models had there being a surplus in those years, but two things happened. The R's didn't let them spend as much as they'd wanted to, but then growth kicked up and the revenues came in, and that gave you significant surpluses way beyond what the Clintons had expected to happen, or much of the country had expected to happen. But growth did it in that case, and we can, these aren't theories, we can point to the Clinton years with significant economic growth flowing from cap gains tax, and that brought down the deficit.
I want to let Jared respond, but panelists, let's remember we're talking to people like me. I'm not an economist. You know, a little more real world, a little less economic theory.
Sure.
But please keep the answers brief because we have got a lot of audience questions.
I actually wanted to see if Marna wanted to get in on this.
We'll see.
I'd be interested in your, would going from 20 to 22 be a problem?
I would. I'm not going to answer. I won't answer that directly. But what I'll answer is certainty, right? So this, when we throw out having this trigger, coverage if we don't get what we want in economic growth, we'd have a triggering mechanism. I think that's probably unconstitutional. The Bureau of Economic Affairs can't regulate that, so I think that's a no-go. But I would say they want certainty, right? So they are making capital investment decisions. They are making acquisition decisions. So certainty is what they want.
On the growth point, again, to me it just sounds like Grover's working very hard to discredit the Clinton years. Now, Bill Clinton raised taxes. The economy did very well. Ronald Reagan cut taxes on net. He raised some, but he cut taxes on net, as Grover said. And the economy did very well. And so the moral of the story is that all of this obsession with how tweaks in the tax code are going to generate or destroy all kinds of growth is nothing more than arguments of lobbyists who are doing the bidding of their clients. That's what's happening here. The growth rate in the economy is a function of its productivity and its labor supply. How fast the labor force is growing, and how efficient that labor force produces. I think that's pretty, and maybe some economics, but I think it's pretty straightforward.
Let's move on to an
and these
audience question.
things do not correlate with changes in the tax code.
Next.
We've heard a lot about the corporate tax rate, but I'm concerned about individuals. We've heard some scary reports in the news about the deductions that are going away. If you sell your house, it's going to be more expensive because of the mortgage deduction, the student loans, the federal and state taxes, and yet the current occupant of the White House says that this is going to be great for the middle class. So, Mr. Norquist, could you just clarify, putting the trickle-down theory aside, because it is totally debatable, I think. Let's just talk about what is being done in this tax bill to directly impact those making $100,000 and less to make it better for them.
Sure. Two things. Trickle down is a name calling by the left. It's not an economic theory. It's what they call supply side economics, or what Sayes would talk about, or Adam Smith would talk about in terms of free market economics. So they can call it names if they want, but we shouldn't suggest that that's an economic theory. But on the question, you start with, right now, the first $12,000 for a couple is exempt from taxation standard deduction. That goes to 24. So the zero rate goes up to 24,000. The 15% rate comes down. Each of the rates come down for individuals. And they also have the higher tax credit for children and dependents, which is temporary, except it's not, and everybody knows it's not, and I dare the Democrats to even think about voting against extending it. They didn't under Biden. Biden negotiated the deal to make it permanent, which we greatly appreciate. But any Democrat would have as well. I mean, those are the issues, but there are three buckets here. When people talk about, well, how does this help different income groups? They leave one off, okay? People make 0 to 10 or 0 to 10 to 20 or 30 to 50, 100,000, 200,000. What they leave out is the 8% of the country that would like to work that's at 0 because they're not working. Okay, we don't have a 4% unemployment
8%.
number. We have an 8% number because 4% say used to be looking and they gave up looking. Okay, they didn't give up wanting a job. They gave up looking because the labor force participation collapsed during a recovery, first in American history. 8%. When we create jobs and opportunities, and it's not just taxes, you're quite right. What Reagan did was not just taxes. He deregulated, with Carter's early support as well, deregulated trucking, rail, buses, and airlines and collapse the cost of transportation in the country significantly. And we're now going through another permitting revolution at the national level where 14, maybe 15 national major regulations were just undone by Congress and banned from ever coming back through the bureaucracy. So the deregulation, why did we go from 2% growth to 3% growth? We haven't cut taxes yet, no, but we've begun the process of deregulating. The FCC, instead of moving towards one direction, is moving back towards the Clinton free market years of the internet, instead of the interregnum that Obama was trying to set up, treating it as utility, using the utility law to regulate the internet like a utility. So when you make those decisions, it's job creation. The guy goes from no job to 20,000. That's not trickle down. If you have $1 million and you want to invest in something, the first thing you got to do is hire somebody to do it. That's not trickle down. The first beneficiary is the guy with a job.
Let's
the
move on.
investor hopes to become a beneficiary.
But I want to understand something. I do want to move on. I want to let Jared respond. Grover, we're basically talking about tax. You're not talking about tax reform in isolation, is what you're saying. Is tax reform is one, tax cuts are one part of this package. That's not all we're talking about. Tax cuts alone may or may not get us there.
The
They're
questioner
a big step in the right direction.
The questioner asked a very specific, good question, which I think you failed to answer. So if you look at the tables, and Grover has them with him, he can show them to you. The family that you're describing initially gets a tax cut in 2018, 2019, 2020, depending on where they are in that range, of anywhere between a few $100 and $1,500, something in that neighborhood. If you then go out to 2025, and the tables will show you that that person then ends up with a tax increase. But as we've said,
if the Democrats vote to do that,
as we've said, it is likely that that will be that the members of Congress will vote against that. So what that leaves you with is the following. And you asked about eliminations and deductions. What that leaves you with is not a debt of $1 trillion. Remember, we're adding to our debt and deficit $1 trillion before the Democrats and the Republicans get together and vote to disallow the phase-outs. And that takes you up to maybe $1.5 trillion, something like that. Now, one of the eliminations in this plan is the inability to eliminate state and local tax deduction. So you can no longer, under this plan, deduct your state and local income or sales taxes. There may well be a $10,000 cap on the property tax. Now, you heard Grover talk about block granting. I want to tie this together in a way that I don't think I hear made very often. When you block grant a program like welfare or nutritional support or infrastructure, we're talking more about middle-class families, when you block grant the kind of program that the federal government helps support, then you're telling states it's up to you to raise more revenue to help support these programs if that's what you want to do. And by the way, look around Cleveland. There's a lot of historical investment here, much of which is paid for by the kinds of tax credits that will no longer be deductible, if they even exist, under this plan. Once you take away the ability to deduct state and local tax payments from your federal liability, it's going to be much harder for states to support these programs. So you're cutting them off at the knees at the same point. At the same time, you probably agree with this.
But you said support. It's difficult to raise taxes again. It will be
or
easier
even sustain
to
the taxes you have. Even sustain the taxes you have. There's going to be pressure to. So you're block granting services to the states, saying you take over. And you're cutting the state's ability to raise the funds that they need to support them.
When we block granted welfare under Clinton, when Bill Clinton block granted welfare to the states all did better financially because they were able to save more money than they received. They were financially better off, as they will be. This will be designed so that governors ask for the block grants because they'll be so much better off with a block grant and flexibility.
Let's see if we can get one more audience question. Let's see if we can get one more audience question in.
Hi. I wanted to thank you all for coming to Ohio, where we have been cutting taxes since 2005 and had much slower growth than the rest of the country as a result of those cuts. And much like Kansas, we have an ineffective pass-through tax deduction, which is what is being created at the federal level, in part through this bill. But my question is really for Jared, which is that When we had the growth that we had in the middle of the 20th century, it was in part because we had the tax structure to invest in people, to invest in K through 12 education, to enable people to go to college, to enable the kinds of investments in infrastructure that our country needed at that time. What will this bill do to our ability to make those kinds of investments in people and infrastructure in the future?
Yeah, the bill will deeply undercut our ability to invest in the future, whether it's to push back on climate change, whether it's to educate the future workforce. And in fact, there are elements in this bill that disincentivize graduate education by making tuition waivers part of your taxable income. So one of the things that educators are upset about is that this bill is going to make education less accessible. But once you start adding $1 trillion, $1.5 trillion, when, as we all agree, they're going to make this, they're going to extend any of these cuts. Once you start adding trillions to the debt and the deficit over time, you're looking at a great difficulty to make the kinds of investments that I would argue some of our older cities especially need and benefit from. I mean, you're absolutely right, and you know, I take it you know the finances of Cleveland and of Ohio, but Kansas is a great example. I mean, Grover doesn't like trickle down, that phrase trickle down. It's a perfect description of the play, which is cut taxes at the top and cross your fingers and hope that they lead to greater investment, faster productivity, more economic activity, more revenues.
Today at the City Club, we've been enjoying a Friday afternoon forum on tax cuts and the Jobs Act. We welcome guests at tables honored by the Cleveland Foundation, by Ernst & Young, and Ohioans for Tax Reform. We thank all of you for being here, and that brings us to the end of today's forum. Thank you, Jared, Grover, and Marna, and thank you, ladies and gentlemen. This forum is adjourned.
For information on upcoming speakers or for podcasts of the City Club, go to cityclub.org.
Production and distribution of City Club forums on IdeaStream are made possible by the generous support of PNC and the Raskin Family Fund, with additional funding from Robert Conrad, Cleveland State University, the Chautauqua Institution, the Cleveland Clinic, and the United Black Fund of Greater Cleveland Incorporated.